exploring digital currencies and blockchain technology. Hey everyone, welcome back to our channel. In the ever-evolving landscape of finance, the concept of money is undergoing a profound transformation. Traditional currencies are facing challenges from emerging digital currencies and the revolutionary technology behind them, blockchain. This video delves into the future of money, exploring the rise of digital currencies and their underlying blockchain technology, and discussing their potential implications for the global economy. Understanding digital currencies. Digital currencies, often referred to as cryptocurrencies, are virtual or digital representations of value that utilize cryptographic techniques to secure financial transactions, control the creation of new units, and verify the transfer of assets. Bitcoin, introduced in 2009 by an anonymous person or group known as Satoshi Nakamoto, was the first decentralized cryptocurrency and remains the most well-known. Since the advent of Bitcoin, thousands of alternative cryptocurrencies, commonly referred to as altcoins, have emerged, each with its own unique features and use cases. Ethereum, for example, introduced the concept of smart contracts, enabling developers to build decentralized applications, dApps, on its blockchain. The rise of blockchain technology. At the heart of most digital currencies lies blockchain technology, a distributed ledger, that records all transactions across a network of computers in a secure and transparent manner. Blockchain operates on a decentralized network, meaning there is no central authority controlling the database, making it resistant to tampering and censorship. The decentralized nature of blockchain technology offers several advantages over traditional financial systems. Transactions are recorded chronologically and immutably, eliminating the need for intermediaries such as banks or clearinghouses. Additionally, blockchain technology enables peer-to-peer transactions without the need for trust between parties, reducing transaction costs and increasing efficiency. Implications for the global economy. The emergence of digital currencies and blockchain technology has significant implications for the global economy, touching various sectors and industries. 1. Financial inclusion. Digital currencies have the potential to bank the unbanked by providing access to financial services to people who are excluded from the traditional banking system. With a smartphone and internet connection, individuals can participate in the global economy, send and receive payments, and access credit and savings opportunities. 2. Cross-border payments. Traditional cross-border payment systems are often slow, costly, and opaque. Blockchain-based digital currencies offer a faster, cheaper, and more transparent alternative, enabling real-time settlement of transactions without the need for intermediaries. This could streamline international trade and facilitate remittances, benefiting both businesses and individuals. 3. Decentralized finance, DeFi. DeFi refers to an ecosystem of financial applications built on blockchain platforms that aim to recreate traditional financial services, such as lending, borrowing, and trading, without the need for intermediaries. DeFi platforms utilize smart contracts to automate processes, reduce costs, and increase accessibility, potentially disrupting traditional banking and finance. 4. Tokenization of assets. Blockchain technology enables the digitization and fractionalization of assets, allowing them to be represented as tokens on a blockchain. This opens up new possibilities for asset ownership, investment, and liquidity, as traditional assets such as real estate, stocks, and commodities can be tokenized and traded on blockchain-based platforms. Challenges and considerations. Despite the promising potential of digital currencies and blockchain technology, several challenges and considerations must be addressed for their widespread adoption and integration into the global economy. 1. Regulatory uncertainty. Regulatory frameworks for digital currencies vary significantly across jurisdictions, leading to uncertainty and inconsistency in legal and compliance requirements. Clear and coherent regulations are needed to provide certainty for businesses and investors and foster innovation in the digital currency space. 2. Scalability. As the popularity of digital currencies grows, scalability becomes a pressing concern. Blockchain networks such as Bitcoin and Ethereum have faced scalability issues, resulting in slow transaction processing times and high fees during periods of peak demand. Scalability solutions, such as Layer 2 protocols and sharding, are being developed to address these challenges. 3. Security and privacy. While blockchain technology offers security benefits through its cryptographic algorithms and decentralized architecture, it is not immune to security breaches and vulnerabilities. Cybersecurity threats such as hacking, fraud, and theft pose risks to digital currency holders and infrastructure. Additionally, privacy concerns have arisen regarding the traceability of transactions on public blockchains, prompting the development of privacy-enhancing technologies. In response to these challenges, developers are actively working on enhancing security measures within blockchain networks. This includes implementing robust encryption techniques and strengthening authentication mechanisms to protect against unauthorized access and data breaches. Moreover, advancements in privacy-focused technologies, such as zero-knowledge proofs and confidential transactions, are being integrated into blockchain protocols to enhance user privacy, while maintaining the integrity of the ledger. However, achieving a balance between security and privacy remains a complex and ongoing process. Collaborative efforts between industry stakeholders, regulators, and cybersecurity experts are essential to address emerging threats and safeguard the integrity of digital currencies and blockchain networks, ultimately maintaining trust and confidence in the security and privacy of digital financial transactions is paramount for the widespread adoption and success of blockchain technology in the future of money. 4. Environmental impact. The energy consumption of blockchain networks, particularly proof-of-work consensus mechanisms used by cryptocurrencies like Bitcoin, has raised concerns about their environmental impact. The energy-intensive process of mining, which involves solving complex mathematical puzzles to validate transactions and secure the network, consumes significant amounts of electricity, contributing to carbon emissions. Transitioning to more energy-efficient consensus mechanisms, such as proof-of-stake, POS, and exploring renewable energy sources could mitigate the environmental footprint of blockchain technology. The future of money is being shaped by digital currencies and blockchain technology, offering unprecedented opportunities for innovation, financial inclusion, and economic empowerment. As the adoption of digital currencies continues to grow and blockchain applications expand across industries, it is essential to address the challenges and considerations surrounding their development and integration into the global economy. With thoughtful regulation, technological advancements, and collaborative efforts, digital currencies and blockchain technology have the potential to revolutionize the way we think about money and reshape the future of finance. If you found this video helpful, don't forget to like and subscribe for more exciting content. Thanks for watching, and until next time, keep chasing your dreams.